Often in estate planning, we're working with clients who have business interests. They're self-employed, they have a large business that employs multiple people, and the entity structure of that business ends up becoming relevant to the planning discussion. It's not a one size fits all when it comes to having a business. Entities work in different ways and they have different tax consequences. And so often what we'll run into is LLCs versus S corporations. How do they work and how do we plan for them? Well, generally, an LLC is meant to be an entity that has a disregarded tax filing status, meaning we're trying to create an entity that can legitimize our business, can protect us from some liability, can create a separate mechanism to act and receive money for the services being rendered or products being sold. But the tax reality is no different than if it was a sole proprietorship. It's essentially being reported on your Schedule C for income tax returns, your 1040. When a business becomes bigger and has very consistent revenue or has revenue over a certain threshold, it's often appropriate for the owner to file what's called an S election. An S corporation is not an entity. The S corporation is a filing status for taxes. And so it allows the self-employed, the owner, the individual who owns the business, to put themselves on a payroll for a reasonable wage and pay themselves profit distributions over and above the salary to eliminate self-employment taxes on the profit distributions themselves. It's often a tax planning strategy that makes a lot of sense for people who have legitimate businesses, not just commissions here or there or minimal revenue sporadically. The planning considerations are going to be very different though. When it's a disregarded entity like an LLC, we can often assign that property or assign that entity into a trust to avoid probate as if we owned it ourselves. There's no tax filing distinctions there. But if we have an S corporation, we would have to refile the S election in the name of the trust if we retitled that entity. So often instead, we will create transfer on death designations for the entity ownership itself, either in the membership operating agreement or on an actual stock certificate, showing that the interest will transfer on death to a trust or to a person if the owner dies. That allows the owner to continue running the property or the entity the way that they always have, but avoid having to refile the S election and avoid probate for the entity.